Welcome back to the deep dive. For today's material, we are actually putting on our Talk Tickers hats.
Oh, I like the Talk Tickers format. It keeps us sharp.
Exactly. So for those of you listening who might be new to this specific format, the mission is simple. We are taking the dense Wall Street jargon from a specific earnings call and translating it into a data-forward, actionable breakdown for you, the retail investor.
And we usually try to do this in under 5 minutes, but the material today is so complex, we're going to need a bit more time.
Yeah, we're going to bend the time rule today, but we are strictly sticking to the 4-part Talk Tickers structure. We'll hit the headline numbers, the story behind those numbers, management's future guidance, and then the bottom line.
Which is where we give you an opinionated take on whether the stock is a buy, a hold, or a sell.
Right. And today, we are unpacking the Q4 2025 earnings call for Artisan Partners Asset Management. You'll usually just see it trading under the ticker APAM. And I gotta say, the setup here is wild.
It really is. It's a complete paradox.
Yeah. Imagine a business that just lost roughly 15% of its most loyal customer base in a single year. Just a mass exodus from the core product line.
Which would normally be a death knell for a company.
Exactly. But then you look at the financial statements for that exact same business, and they hit all-time high revenues, posted massive profits, and just paid out a staggering 9.5% dividend to their shareholders.
Yeah, it creates this sense of cognitive dissonance. You're staring at a ledger that seems to be describing two completely different realities occupying the same space.
Right. On one hand, you have this fortress of cash generation. On the other, a glaring structural leak. So let's jump straight into step one of Talk Tickers. The headline numbers. Okay, let's unpack this.
Let's do it.
APM ended 2025 with an all-time high of $180 billion in assets under management. That's a 12% jump year over year.
Again, asset management, that AUM number is everything. It directly fuels the revenue engine.
Right. And because of that AUM bump, their fourth quarter revenues hit an all-time high of $336 million. That is a 13% jump from the prior year.
Which are just incredibly robust top-line figures. But, you know, a high top line is only half the equation in finance.
Exactly. You got to see what actually makes it to the bottom line.
Right. The real question is how efficiently the firm turns that revenue into actual profit. And when we look at APM's profitability, their adjusted net income per share was up 20% compared to Q4 of 2024.
A 20% jump in net income for a mature asset manager is huge. But the number that actually stopped me in my tracks was their adjusted operating margin.
Oh, the 40.2%.
Yes. For the fourth quarter, their operating margin was 40.2%. That's an improvement of 400 basis points, so a full 4 percentage points from just the prior quarter.
It is a remarkable figure. And I think to truly appreciate it, we need to quickly talk about how operating margins work across different industries.
Yeah, please do, because it's easy to lose context.
Well, the operating margin is essentially what's left over after you pay the day-to-day costs of running the business, right?
Yes.
Salaries, rent, tech, marketing. This is before taxes and interest.
Right. And if you look at the broader economy, a 40% margin is almost alien.
Totally alien.
I mean, think about a major grocery chain. They might operate on a 2 or 3% margin. They're buying perishable inventory, running huge trucking fleets, paying thousands of frontline workers.
Yeah, the capital intensity is a massive anchor on their profitability. Even a super successful airline is thrilled to hit a 10% margin.
Exactly. Which brings me to this analogy I keep thinking about with APAM. Looking at a 40% margin, it reminds me of the economics behind a luxury Swiss watch.
Oh, that's an interesting way to look at it.
Right. Because when you buy a $20,000 mechanical watch, you aren't paying for $20,000 worth of steel and glass. The raw materials cost maybe a few $100.
You're paying for the brand heritage. The engineer.
Exactly, the specialized intellectual capital. And asset management functions on a very similar premise. APM is essentially selling intellectual horsepower.
Right. They don't have factories or supply chain bottlenecks.
No. Their primary inputs are human capital, highly skilled portfolio managers, and some software and office space.
And that intellectual capital model allows for just intense operating leverage.
Right.
When they scale up, they don't have to build a new factory.
Right.
If a portfolio manager is running $1 billion fund and another $1 billion flows in, the manager doesn't suddenly do twice as much work. They're researching the exact same companies.
So the fixed structure of the business stays stable while the revenue just scales infinitely. And the CFO, CJ Daly, actually highlighted this dynamic on the call.
Yeah, he pointed out that while total expenses went up, Their core fixed compensation costs actually declined a bit.
Right, because they operate on a heavily variable cost model. When the firm makes more money, the investment teams make more through performance bonuses. But the base salaries for the back office, the rent, those don't automatically go up.
Exactly. So when revenues spiked to that record $336 million, the fixed costs essentially stood still. A huge portion of that new money flowed cleanly to the bottom line,
Expanding the margin to that 40.2%. Though, to be fair, you did mention there were some accounting true-ups that helped that number, right?
Yeah, we should note that it wasn't purely operating leverage. The CFO mentioned a true-up of self-insurance liabilities.
Okay, let's translate that for the retail investor. What does a self-insurance true-up actually mean for the business?
Basically, large corporations often self-insure certain risks, like employee health care, instead of paying massive premiums to an outside company.
Okay.
They estimate the cost for the year and set aside a liability on the balance sheet. A true-up happens at year-end when actual claims are way lower than estimated.
Oh, so they get to release that unused money back into the income statement.
Right. It acts as a one-time reduction in expenses, temporarily boosting the margin.
That makes perfect sense. He also mentioned some long-term incentive expenses were lower because a few employees left before their stock vested.
Yeah, they left that unvested stock on the table.
But even stripping those one-time benefits away, the core profit engine here is incredibly powerful, which leads to what they do with all that profit.
This is the part income investors are going to love.
Oh, absolutely. APAM declared a total of $3.87 per share in dividends for 2025. Based on the year-end stock price, that is a staggering 9.5% dividend yield.
And we have to give that 9.5% figure some serious context.
Okay.
Because normally a yield that high in the public markets is a massive red flag.
It's the classic yield trap. When you see a 10% yield on a stock screener, your first instinct shouldn't be to celebrate. You should be looking for the fire.
Exactly. Usually it means the stock price just plummeted and the market knows a dividend cut is imminent. The cash flow has dried up.
Right. Or it's a highly leveraged mortgage REIT taking on massive debt just to sustain the payout.
Which totally erodes the long-term equity value. A yield trap happens when the payout ratio is fundamentally unsustainable. If you earn $1 but pay out $1.50, you're borrowing the difference.
Eventually, the music stops. But the CFO's commentary suggests APAM is operating in a completely different reality. He stated the $3.87 payout is a 98% payout ratio on their adjusted earnings.
That is the crucial distinction. They aren't borrowing money. For every dollar of adjusted profit they generated, they returned 98 cents directly to shareholders.
The transparency is wild. They basically view the company as a pass-through vehicle. Generate the cash, secure the balance sheet, and flush the rest to the investors.
And that balance sheet is aggressively conservative. They reported $114 million in cash. Practically zero leverage.
Yeah, like 0.4 times earnings, plus a $100 million undrawn credit facility. They've built a fortress.
And they even increased the payout. The 2025 dividends were an 11% increase over 2024.
So, summarizing the headline numbers, AUM is at an all-time high. Revenues are at an all-time high. Margins over 40%. A fully funded 9.5% yield with no debt.
It sounds flawless.
Right. If you stop reading the transcript here, APAM looks like the single greatest stock in the financial sector.
It does, until you dig into step 2 of talk tickers, the story behind those numbers.
And this is where the narrative completely fractures. Because we have to figure out how that $180 billion actually got there.
Right. In asset management, your AUM goes up through 2 completely separate mechanisms. And you really need to understand the difference between the 2.
Okay, break them down for us.
Mechanism 1 is organic growth. This is the holy grail. It means your managers are delivering great returns or your sales team is crushing it and clients are bringing you brand new money, net inflows.
Which proves the market actively wants what you're selling.
Exactly. Mechanism 2 is just market appreciation. Your AUM goes up simply because the underlying stock market went up.
Right. If you manage $1 billion and the S&P 500 jumps 20%, you suddenly manage $1.2 billion, even if 0 new clients signed up.
Exactly. So when we isolate those 2 variables for APM, the data paints a very stark picture. Over $33 billion of their AUM growth was driven purely by investment gains.
Wow. The broader market, helped by their stock pickers, to be fair, did the heavy lifting to inflate the AUM.
But when you strip away that $33 billion market tailwind and look exclusively at actual client capital flowing in and out, the reality is pretty sobering.
Yeah, the CEO, Jason Gottlab, was actually incredibly candid about this. The core equity platform, which is the historical foundation of the firm, suffered what he called higher than expected outflows.
And the specific number is painful. The equity platform had a 15.6% outflow for the year.
A 15.6% organic outflow. That means more than 15 cents of every single dollar entrusted to their traditional equity strategies was actively redeemed by clients and walked out the door.
It's a massive contraction happening right underneath the surface of those record revenues.
Management noted the bleeding was concentrated in three major strategies: global opportunities, U.S. mid-cap growth, and non-U.S. small mid growth. So the obvious question for you listening is, why? If the firm is printing money and overall returns are exceeding 20%, why are clients fleeing these specific funds at such an alarming rate?
Gottlieb pointed to three distinct catalysts. First, challenging short-term performance in some of their biggest funds. The industry is notoriously unforgiving about recent performance.
Yeah, institutional clients like pension funds employ consultants who ruthlessly monitor one-year metrics. If you lag your benchmark for a few quarters, they pull the capital.
But his second and third points suggest something way more systemic. He cited changing asset allocation preferences and, paradoxically, profit-taking on the back of strong long-term performance.
Okay, let's break down the profit-taking mechanism. Because to a retail investor, taking money out of a fund because it performed too well sounds completely counterintuitive. Why punish success?
It comes down to the rigid mechanics of institutional rebalancing. Imagine a massive state pension fund managing tens of billions. They have a strict, board-approved mandate.
Like they have to hold exactly 10% in international value stocks to manage risk.
Exactly. So they hire APAM's team to manage that specific 10% slice. Now, assume the APAM manager does a phenomenal job over 3 years.
The stocks they pick surge in value.
Right. Because of that outperformance, that international value slice grows and suddenly represents, say, 14% of the pension fund's total assets.
Oh, so they are now out of compliance with their own risk mandate?
Correct. They don't fire APAM, but they are forced to withdraw the excess gains, that 4% overage, just to shrink the allocation back down to the target 10%.
They just take the profits and redistribute them to underperforming asset classes to keep everything balanced.
Gottlieb explicitly called this out. The equities book outperformed over the long term, creating a natural rebalance flow out of the firm.
I mean, I understand the math, it's mechanical and emotionless, but still, a 15.6% outflow across the whole platform represents billions of dollars leaving. Rebalancing alone can't explain a hemorrhage of that size.
No, it can't. Clients are actively choosing to take their money elsewhere. And that leads to the most formidable headwind facing the entire active management industry right now.
The passive revolution.
Exactly. When Gottlieb said changing asset allocation preferences, he meant the relentless shift from active stock picking to passive index investing.
We really need to dive deeply into this because it is the fundamental context for everything happening to their business.
For decades, the mutual fund model dominated. You gave your money to a highly educated portfolio manager who researched companies to beat the market. For this, they charged a management fee.
Right, and in APAM's case, their average fee rate is roughly 74 basis points, or 0.74% a year, which used to be considered a very fair price.
But then, exchange-traded funds, or ETFs, blew up. These passive funds don't employ analysts. They just run a computer algorithm that buys every stock in an index, like the S&P 500.
Because there's no expensive human research, they charge incredibly low fees. You can buy a broad S&P 500 ETF today for like 3 basis points.
0.03%. And mathematically, it has proven extraordinarily difficult for human stock pickers to consistently beat the market average year after year.
So institutional clients look at the data and ask, why am I paying APM 74 basis points to try and beat the market when I can pay an ETF provider 3 basis points to just match it?
That is fee compression in a nutshell. When APM has a quarter of short-term underperformance, the client doesn't just switch to another active manager. They throw their hands up, capitulate, and move the capital permanently into a passive index.
And that money never comes back. So we see the structural decay clearly. But this raises a glaring mechanical question for talk tickers. If their main revenue engine is leaking 15% of its assets, how on earth did they grow Q4 revenue to an all-time high of $336 million?
You can't shrink your base by 15% and logically report an 11% sequential revenue jump.
Exactly. How did they do it?
Two immense forces counteracted the outflows. The first we discussed, the $33 billion market rally. The market bailed them out by inflating the value of the remaining assets faster than clients could withdraw them.
A rising tide masking the leak in the hull.
Yep. The second force was a highly specific cyclical revenue boost, performance fees. The CFO detailed that the December quarter included about $29 million of performance fees.
Okay, let's explain performance fees because they function very differently from that standard 74 basis point management fee.
The standard fee is charged no matter what. The fund goes up, goes down. APM still collects their percentage. But for certain funds, APM negotiates a dual fee structure.
Right. They charge a lower baseline fee, but add a clause that activates only if the manager beats a specific benchmark by a certain percentage.
It functions as an aggressive profit-sharing mechanism, a bonus for genuinely delivering alpha.
If the manager crushes the benchmark, APM takes a cut of that outperformance. And $29 million is a massive injection of high-margin revenue for a single quarter.
It is. But the CFO added crucial caveats. Only about 3% of APM's total AUM is actually subject to these performance fees.
Wow, only 3%.
And the vast majority of these contracts have an annual measurement date right at the end of December. They calculate the full year of outperformance and crystallize the fee in Q4.
Which means the $29 million is basically a one-time end-of-year bonus. It's not recurring revenue. You can't assume they'll make that again in Q1.
And you certainly can't rely on the stock market appreciating 20% every year to mask the core equity outflows.
Management has to know that relying on market tailwinds and volatile performance fees is totally unsustainable.
They are deeply aware of it. And that awareness is driving the most significant strategic pivot in the company's history. Recognizing the decline in traditional equity funds, APM is aggressively pivoting to asset classes where active management still commands high fees.
The alternatives and credit spaces.
Exactly. And the numbers there present a stunning contrast. While equities lost 15%, APM's credit AUM grew by an impressive 29% year over year.
They generated net inflows, actual organic new client money of $2.8 billion in credit. That's 3 straight years of over 20% organic growth.
Clients are actively seeking out their credit expertise. And the alternatives platform grew 20% year over year to hit $4 billion.
But we have to keep the scale in perspective for the listeners. A $17 billion credit platform and a $4 billion alts platform are great, but they are dwarfed by the massive gravity of the $180 billion total firm AUM.
The legacy equities still dominate. The growth in alts and credit isn't large enough yet to replace the revenue walking out the door.
Which is why APM cannot afford to rely purely on organic growth to scale these new platforms. They are deploying that pristine balance sheet to execute targeted M&A. And the centerpiece of this call was the Grandview Property Partners acquisition.
It's a fascinating deal. It's a profound expansion of APM's historical identity.
Yeah, Artisan Partners has always been public market securities, stocks and bonds. Grandview is a real estate private equity firm.
A complete departure into the private markets. Grandview originates, develops, and manages middle market properties across the U.S. This is APM's 12th autonomous investment franchise.
We should definitely define what they mean by autonomous investment franchise. It's core to how they operate.
Many large asset managers operate like the corporate board. They buy a smaller boutique firm, strip out its unique culture, force the managers to use centralized research, and make them adopt the parent company's macro outlook.
Yeah, they just assimilate them.
Exactly. APM's philosophy is the exact opposite. They seek out established teams like Grandview's founding partners who have worked together for over 20 years. APM says, we aren't going to tell you how to invest in real estate. You are autonomous. APM simply provides the institutional back office support, compliance, and their massive global distribution network.
It's a plug-and-play scaling model. Grandview currently manages about $880 million in institutional assets. They've raised 3 discretionary closed-end drawdown funds since 2018.
And that structure, a closed-end drawdown fund, is exactly why APM wants to expand into private markets.
Let's contrast this with traditional mutual funds. Because if I buy an APM mutual fund today and the market crashes tomorrow, I can log into my brokerage and sell my shares instantly.
The capital is completely liquid. That daily liquidity is what enables a 15% annual outflow. Investors can panic and pull their money.
But you cannot panic sell a massive industrial warehouse overnight. Private real estate is inherently illiquid.
It fundamentally alters the revenue stability. When Grandview raises a new fund, investors commit, say, $200 million. Grandview doesn't take it all on day one.
They draw it down incrementally as they buy specific properties.
Right. And the critical mechanic is that the investor's capital is legally locked up for the lifespan of the fund, which is often 5 to 10 years.
So from APAM's perspective, they are acquiring incredibly sticky capital. That money cannot leave in a panic if the Fed raises interest rates.
APAM locks in a highly visible, guaranteed management fee stream for years into the future. It's the ultimate hedge against mutual fund volatility.
And Grandview's strategy is heavily focused on industrial, residential, and power land themes, which immediately stands out given the current infrastructure boom for data centers and AI.
By acquiring Grandview, APAM is buying direct access to management fees generated by those massive macro trends. And the way they source this deal speaks to their capital discipline. Gottlieb emphasized it was an off-market deal.
Let's translate that. What does an off-market deal actually mean?
Usually, when a boutique firm wants to sell, they hire an investment bank. The bank shops the firm to dozens of buyers and orchestrates a highly competitive auction to spark a bidding war.
Right, trying to extract maximum value. But the winner usually suffers from the winner's curse. They overpay so aggressively it takes years to generate a decent return.
Exactly. Gottlieb said deals shopped by bankers are hard for APAM to get excited about. An off-market deal means there was no auction.
Yeah.
APAM and Grandview cultivated a quiet, direct relationship over time.
They aligned on culture and autonomy without a banker artificially inflating the price tag. And APAM plans to leverage their distribution network immediately.
Which brings us perfectly to step 3 of Talk Tickers, management guidance.
Yes. We've dissected the past. Now let's look at the future. Starting with the Grandview fund sales. What's the timeline?
Gottlieb confirmed they are effectively launching Grandview's Fund 4 as we speak, targeting a first close by early to midsummer.
And they established a very ambitious expectation. They anticipate Fund 4 to be significantly higher in raised assets than the previous fund, which brought in roughly $150 million.
This is the core synergy of the acquisition. Plug a proven team into a massive global sales engine. We actually just saw this playbook execute flawlessly with their emerging markets campaign.
Yes, the velocity of that asset gathering was incredible. Gottlieb revealed they raised north of $1 billion in just over 5 months for their emerging market strategies.
Over $100 million in net inflows for each of their 4 distinct EM strategies in that short window.
Raising $1 billion in fresh capital in 5 months just by focusing the sales team proves that APAM's distribution engine is still incredibly potent.
If they offer the right product.
Yeah.
And they're trying to build these specialized lifeboats, credit, Grandview, emerging markets, fast enough to offset the decay in the legacy equity business.
So if they're launching products and integrating acquisitions, what does that mean for their expenses? Can they maintain that 40% margin?
The CFO guided that fixed expenses for 2026 will increase only by low single digits, mostly just merit-based salary adjustments and rising tech costs.
Low single digits basically mirrors inflation. That's a vital signal. Management is keeping a draconian grip on fixed costs.
The variable cost discipline is holding. However, there is one massive expense line item: long-term incentive compensation, or LTI.
Right. The CFO noted the board approved a 2026 LTI award totaling approximately $72 million, consisting of cash-based franchise capital awards and restricted stock.
Because of that grant, long-term incentive amortization expense will hit about $85 million for the full year of 2026.
An $85 million expense is massive. Why are they authorizing so much? What is a franchise capital award?
We have to go back to the luxury watch analogy. APM's product is intellectual capital. At 5 p.m., the core assets of the firm get on the elevator and go home.
Right. The base risk isn't a market crash. It's a star portfolio manager walking across the street to start a competing hedge fund, taking all their clients with them.
The firm's stability relies entirely on retaining talent. So this $72 million grant is an incredibly complex retention mechanism.
So how does the franchise capital award specifically work?
Instead of giving a manager generic stock in APAM, they grant the manager a direct economic interest in the specific franchise they run. If their specific strategy grows, the value of their personal award grows.
They're essentially equity partners in their own boutique firm under the APAM umbrella, and I assume these awards vest over time.
Exactly. They vest over several years. If a manager gets frustrated and leaves early, they legally forfeit those unvested awards. They leave millions on the table.
Which makes it financially irrational to leave. So $85 million is a massive expense, but it's the necessary cost of securing the intellectual capital.
It is. But management also outlined some external headwinds in their guidance. Specifically, Gottlieb expressed significant caution about the institutional client base in Europe.
Yeah, he said they are probably a little bit more at risk in that region right now. What's driving that?
A confluence of two factors. First, a heavily evolving regulatory landscape, primarily driven by directives like MiFID II, which forces intense fee transparency and unbundling of costs.
Plus the heavy ESG compliance requirements in Europe, it just adds expensive regulatory friction.
Exactly. And that friction compounds the second factor, the relentless active versus passive debate, which is particularly acute in Europe right now.
Right. If a manager underperforms their European benchmark for a year, the pension consultant just points to the high fees, the complex regulations, and moves the capital to a Vanguard ETF.
Gottlieb summarized it perfectly. Clients in Europe are hitting pause and defaulting to cheaper passive alternatives. So gathering organic assets in Europe is going to be a grueling slugfest.
Which circles right back to the importance of their M&A strategy. If organic growth in Europe is stalling, buying established asset pools like Grandview becomes a strategic imperative.
And Gottlieb confirmed they are actively hunting for more off-market deals, expanding into private credit, private equity secondaries, and hybrid credit.
Let's quickly define private equity secondaries for the listeners.
We talked about how private funds lock up capital for 10 years. If an institutional investor desperately needs liquidity early, the secondary market is where specialized firms buy those locked up stakes at a slight discount.
It's a complex, data-heavy market that commands premium fees. Entering that space would be a massive high-margin expansion.
And they have the financial firepower. $80 million in retained excess capital earmarked for investments, zero leverage, and $100 million revolver.
But they are remaining disciplined. Not just buying AUM for the sake of it, strictly hunting for autonomous, high-functioning teams.
Which brings us to the final phase of talk tickers, the bottom line.
Okay, here we go. We've synthesized a ton of contradictory data: record revenues, massive margins, structural equity outflows, passive headwinds, aggressive alternative expansions. So, what is the ultimate verdict? Bullish or bearish?
We have to split the verdict in half. From a pure balance sheet and cash flow perspective, the signal is unequivocally massively bullish.
I have to agree. The financial horsepower is undeniable. A variable cost structure that instantly expands margins to 40.2%, pristine leverage, and a policy that returns 98% of adjusted earnings to shareholders.
A fully funded 9.5% dividend yield backed by tangible cash flow. If you're an income investor, APM is a fortress. They are piping management fees directly into your brokerage account.
But the other half of the verdict demands attention.
Yes, when you analyze the organic growth trajectory of the enterprise, the core operational health, the signal leans slightly bearish.
Anchored entirely by that 15.6% outflow in the legacy equity platform.
You cannot ignore that the historical engine of the firm is suffering a structural contraction. When 50% of assets are actively redeemed in a year where the broader market was up, it proves selling traditional mutual funds is incredibly difficult right now.
The firm was bailed out this year by a $33 billion market tailwind and cyclical performance fees. But hope is not a corporate strategy. You can't assume the S&P 500 goes up 20% every year to mask the bleeding.
To their credit, management isn't relying on hope. They are actively rebuilding the airplane in mid-flight.
Which provides the most actionable framework for the listener. If you are an income-focused investor seeking a high yield, and you are comfortable accepting that the stock price might not aggressively appreciate because the core business is shrinking, APM is doing exactly what you want.
But if you are analyzing APM as a growth stock, your thesis hinges entirely on monitoring their strategic pivot. Can the new high-fee platform scale fast enough to replace the mutual fund revenue?
You have to watch the Grandview integration. Can they launch Fund 4 and raise significantly more than $150 million? Can they keep raising billions for emerging markets and credit? Can they execute more off-market M&A without overpaying?
You have to monitor the internal composition of that $180 billion pie. If the alternative and credit segments grow rapidly while the equity bleeding stabilizes, the transformation is working.
But if equity outflows accelerate, and the Grandview scaling stalls, that cash flow supporting the 9.5% yield might eventually face pressure.
It is a race against time between the decline of an old business model and the construction of a new one. But they have a massive cash cushion to fund that transition, unlike their leveraged competitors.
We started looking for a simple narrative, but this is a complex case study of a legacy manager buying its way into the future of private markets.
The surface numbers never tell the full story.
Thank you for joining us on this deep dive into APAM's Q4 earnings. We hope this breakdown gives you a more rigorous framework for evaluating the companies in your own portfolio.
And as we close, this raises a profound question to consider. We've documented the relentless shift to low-cost passive index funds. As Vanguard and BlackRock devour the market share of traditional stock pickers, will APAM's survival strategy eventually force a complete corporate metamorphosis?
Will the Artisan Partners of 2035 even be recognizable as a stock-picking firm?
Exactly. Will the passive revolution force them to morph entirely into a specialized, closed-end private market powerhouse over the next decade? It's a slow transformation playing out right in front of us, one earnings call at a time.